Hello traders, boys and girls, it's Nick here. I hope you can all hear me, most of you. Can you also see my pretty chart? Just a quick question, just give me a quick yes. And then we can start immediately. Perfect. That's it. So yeah, welcome to our three-step formula. It's a two-hour thing, I guess. We need at least 1.5 to 2 hours to explain everything, and we will start immediately. I'm also happy that I see a lot of names I know and a lot of new names also. Great. Yeah, also let me introduce you to Jeff Wild. Dr. Jeff Wild is here, will answer your questions. I also see Gail in the room. She is with us a long time and she knows her way around for sure. She will be able to answer questions as well. The thing is, when we start, the best thing to do this is I usually explain to you how things work, right? We just move on, and if you have questions, have a piece of paper somewhere close by, make your notes, don't ask the questions in between, so we can continue. And afterwards, every time I explain something, I will ask you, of course, if you have any questions, and then you can shoot and we will discuss everything. I'm happy to answer all of your questions. Is that okay for everybody? Just a quick yes. Perfect. So let me see if that works here. We have our simple three-step trading success formula. The 3 steps are here for you to see. I'm not sure, just give me again a quick yes to make sure you see what I see. Step 1, step 2, step 3. Perfect. So why do we need these 3 steps? Out of experience, to make it really simple, if you don't follow the 3 steps, it's very hard to grow accounts steady over the long run and make things work without stress. Okay, so it's that simple, really. And it's not only me using this, but most of my students are doing this, especially the older ones in the room already. I see a lot. And hopefully everybody else is able to do that in future as well. Now, to make it easy and to show you why it's so important, we do it. We just start immediately and explain these things on charts instead of trying to do this just here like this. Okay, give me just a second. I'll see people trying to contact me through Skype. Was it difficult for you to log in? No, okay. So then I mean it's not a problem really, because I'm recording everything. Yeah, so in case you have trouble with audio, you just watch the recordings later on. Yeah, so let's start immediately so we can really dive into it immediately and have fun. Step 1, I read it to you. I mean, you can read it yourself, but let me read it. It makes things more powerful. Is understand the markets by reading charts 100% correctly. Then identify a trend or market range on high time frames and look for trading setups according to the trading system and your trading plan only. Yeah, I use a Spartan system, of course. Members also. It doesn't matter even if you are a big fan of something else, you still have to follow the steps. Okay, I'm going to explain the basics of the Spartan system today on these examples, and I'm going over one strategy, the swing trading strategy, which is easy and simple to explain and very, very powerful. Okay, and every time we look at a chart, we want to follow these steps, and we do this today together. So step 2 is Let's read it again. If the signal is triggered, you don't hesitate. You trade by splitting your positions into multiple parts, and never expose your trading account more than 1 or 2% risk. So what I mean is, like, even if you have 2, 3, or 5 positions running, all positions together should not expose the account to more than 1 or 2% at any time. Okay? Your goal is to stay in a trade as long as possible, especially when you ride a trend. If the price goes your way, and you look always for bigger targets and trade your stops according to the system rules, right? So if the price goes your way, I mean, if the trend is really strong and it's breaking support, if it's a short trend, or resistance if an uptrend, and it moves higher, then you want to look for the next support or resistance area, so the next targets. I think everybody understands that, right? Basically. And then step 3, the markets never move in one direction without taking a breather, which means a pullback or retracement. And you take advantage of these pullbacks on lower time frames by locking in profits. So you hedge up the positions. You will make incremental profits on the pullbacks and leave the main trend positions running according to the trade management rules, always. I mean, money management and, of course, entry management. Now repeat these 3 steps again and again. That's it. So you have to know what you're doing. Very, very important that you understand what you're doing. Okay. You go for the trade. You try to stay in as long as possible. You don't risk much. You're not gambling. You're trying to trade. You try to grow your account and have fun doing this. And when you see the market is retracing in bigger trends, you know that it has to breathe. So it creates what we call 1, 2, 3s or ABCs, right? And these retracements, you can take advantage of the retracements by taking trades there on lower time frames. And that's what we're going to do now on 2 examples. And they are both live examples. That means traders took these trades, and members that we have. And I also know that Jan has still one of those positions running on GBP JPY, and that's exactly what we're going to cover this live trade. Because yes, you might say, hey, yeah, for you it's easy, but to make it easier for you, I share examples that students and members took, trades that have been taken by traders, by members. Okay, before we dive into it, do we have any other questions? Because I see you writing a lot. Let me check this out first. I just explained, I think, what we're going to do, right? So is everybody okay so far? Yeah, it's the basics of finding good trades to enter and keep the positions in bigger trends or in bigger ranges, but also hedging up these positions. Okay, these are the basics. And what you are looking for, Duncan, is probably the hedge course, which is next week. I will talk about this afterwards. When we are finished here, I will explain to you what we do next week, okay, in case you don't know already. Great. So there we go. Let me get rid of this just for a second. Step 1 again. Understand the markets by reading charts 100% correctly. Then identify a trend or market range on higher time frames and look for trading setups according to the trading system and your trading plan only. And that's what we're going to do right now. Step 1. Get rid of this. Now you should all be able to see my chart and it's a GBP JPY weekly chart. Yes? Everybody? Kathy, I see you are in the room as well. Sorry, I wanted to ask you for some charts on the USD CAD swing short you have and some hedged positions there. I forgot to ask you about that, to send me some charts, but it's okay, you can send them later on maybe. I have John's charts here ready, okay? Thank you anyway. Perfect, so I let all the members help me here. We have a weekly chart. Why do we use a weekly chart? When we want to trade, when we look for any setups, what's the first thing we want to do? Yes, we open a chart. We have, you know, in this case, the GBP/JPY on our screen. So what's next? Yeah, exactly. Yeah, we want to look for the direction, trying to figure out if we have a trend or if the market is ranging. And then the next step, of course, would be looking for support and resistance. But the first thing we want to do is we want to figure out whether we have a trend or range generally. And to do this, in order to do this, we need to look at the weekly chart. And this is something, and most of you know that, most traders don't do. They look at 5-minute charts, 50-minute charts, maybe 1 hourly and 4 hourly chart, but nobody looks at daily, or a few people only look at daily charts, and weekly and monthly probably nobody. So the weekly chart is big enough. Okay, of course, if it's the first time you look at any charts, then you can also start with a monthly chart and trying to figure out what's going on. But all in all, important, you see it's clearly visible here, the price is going up. Switching to the weekly chart, you can see the same thing. So does everybody agree just on the weekly chart that this is a powerful uptrend starting from 2012? I think yes, right? And for the new guys, sorry, I didn't say this, I didn't explain this because we use it every day. This chart, for this chart, especially for the Spartan system, we like to use Heikin-Ashi candles, okay? So you can see the Heikin-Ashi candles, what they do, they measure the strength of sellers and buyers. So you have a white candle or green candle, whatever color you like to put in there, indicates power for buyers. And if it's red, it's going down, of course, then the sellers are stronger. And that makes it really easy for your eyes. It's not complicated, simple, and you can see if the buyers are stronger or the sellers. Okay, and then also what we use, what I like to use are 4 EMAs. The blue one is the 12 EMA, and that just indicates or follows actually the volatility of the market. As long as it's kind of touching or almost touching the candles, I know it's a powerful trend, especially of course when the candles are over the blue line, and if they're below, like if you scroll back, of course, then you have volatility, but for shorts. And the 36 EMA, which is my favorite, what it does, it follows the trend, and as long as the price moves higher and the 36 EMA is below the price, then you have a very powerful uptrend. Okay, everybody okay so far? I want to do it step by step, don't want to stress you at all. Okay, perfect. Now we have 2 other EMAs which are really not important today. The 633, which in combination with horizontal support and resistance areas are very, very powerful, and also the 200 EMA, which is Also very powerful in different, let's say, using different strategies here, but we don't need them really today. So what I'm going to do, I delete those for now to make it really easy. Okay, so we have the Heikin-Ashi candles, we have the EMA 12 and the moving average 36. Okay, exponential moving average, both of them. Now, you said this is an uptrend, yeah? But how do we know that? Price is moving higher, okay. That's it. Price is going up. You could also see one big candle going up. That would not mean that the price is an uptrend, right? The uptrend is easy to spot when you see, first of all, a trend line break. Then, of course, you want to see the price moving over the 12 and the 36. We also like to see a crossover, like the 12 crossing the 36, right? But ideally, and yes, there we go. What we want to see on a chart is that the price actually, after breaking a trend line, we can draw one here. What we need for a trend line, you probably know, is 3 touches. Like price should move in one direction. In this case, it's going down, it's coming back up, it's creating lower points on the chart, coming back up. And when you connect the retracements in this down move, you connect the 3 touches, then you have usually a very, very powerful trend line. Okay, and the way we do it, we connect the touches not at the highest point of the candles, but between the bodies and the tails, because the price never really stops exactly at a touch. Yeah, sometimes it's breaking a line, sometimes it's stopping a little bit earlier, or it's spiking and then coming back. So you need the 3 touches visible on the chart, and as long as you have 3 touches after the price moves in one direction, in this case down, you have a powerful trend. Okay, when that trend line breaks, especially on the weekly chart and on the daily chart, you have probably a trend change, or you're getting close to it, right? Now, what do we have here? If you look down at this point, before the price breaks the trend line, you see the first signs of weakness in terms of lower points on the chart. The price is not creating lower points anymore, right? It's kind of a double bottom. It's hitting your resistance line, and the price comes back down, but here it creates a higher low. Correct? This low is higher than this, and then another low which is higher than this. So you have the first signs of a possible trend change down here, where you connect to 1, 2, 3 touches. This doesn't mean much if afterwards, if the price in the end moves lower, but it's the first sign. And when these things happen, especially on the lower time frames, on the higher time frames, you have time to see what's going to happen, but on the lower time frames, these are very important signs. Okay, and you watch closely, and what you need then is the price breaking those lines. Okay, and especially the EMAs. Okay, and then breaking the trend line, the powerful trend line here, and moving higher. And then you have really good sign. You could say this might end up being a trend change, and if the price breaks this, for sure, and you have candles moving higher, then you have a trend change. On this higher time frame, to make sure it really is a trend change, only on this higher time frame, of course, you want to see the price creating new highs, and then you want to see the price coming back to support. Ideally, what we want to see is the price coming back to the 36 EMA, because that would tell us that the price is actually taking a big breather, retraces a lot. Okay, but sometimes it won't do this. It only retraces back to the 12 EMA. On the higher time frames, this is still okay, but this is the actually prove that you have a trend change, because after that the price creates higher points on the chart. Okay, so there we go. Then the price retraces in the end almost back to the 36 EMA. And price is creating a higher point on the chart again, coming back only to the 12. So it's retracing, and afterwards it doesn't really retrace back to the 36, too much power. But you know what, if you are long, you don't mind, you are okay with that. It takes a breather again, and then you can see it starts ranging a little bit. The price is still creating higher lows, yeah, but not really higher highs at the moment. This here, what you see here, the retracements, are actually telling you that you have a powerful trend, because every time the retracement is over, like it's retracing, the price creates a higher point on the chart. So you have a higher high, a higher low, a higher high, and a higher low. These are the 1, 2, 3s we are talking about, or the ABCs. Is that okay so far for everybody? Am I too fast? Should be okay, right? Perfect. Now, okay, you know that we have a powerful trend here, but the price is up here in this area. You want to know what to do next. That's cool. Before we go and do this, you know, before we go here, you first need to understand what you are looking for. That's why I said you need to understand what the market is doing. If you don't really know, just more or less, this is not good, right? This means trouble for you in your trading account. So, okay, so far, let me get rid of this. You have a trend change here. You have higher highs and higher lows. You have a very powerful trend. Now you don't need to draw this on the higher time frame anymore, because just by looking at it, you understand that this is a powerful trend. In order to make sure you find also powerful support areas in this trend, because you want to know every time the price is retracing, how far will this retrace? Likely, at least, you never know really, but how far could this retrace? And you never really know until you have your 2-3 touches or more touches. That means you have a support line in this case, because it's an uptrend. You want to look for your support line. Okay, you know the price creates higher highs all the time here, and then it retraces. You have higher lows, but where is your support? You know the 36 is the guide. You also know the 12 EMA is the volatility guide, but you see the price does not exactly stop at the 36. Sometimes it does it, but not always, and not, of course, on all time frames. So what you have to do, you have to draw a trend line again. Yeah, so from down here, when you started, when it was, you know, the beginning of this trend, you did it like this. Then you had down here your first touch, the second touch, a third one, you extended the line, the fourth one, and then you had a range. Okay, and what happens when the market starts to range, you don't get nervous or something. You can continue drawing a line. You just have to change the angle of your trend line. In this case here, you could do it like that, because in the end the price moved higher. So this line is now, this touch here is very powerful. You can also ignore the first touch and start drawing it from down here, because now you have again 3 touches, right? 1, 2, 3, and you extend the line and it ends up here. This touch here and here in this area, more or less, and you extend it and it's ending up here. So when you don't know, you know, if it doesn't look that great anymore on this chart, or you say, look, I could draw the line like this, and then it's ending up down here. 1, 2, 3 extension, and right at that point, by the pip, it almost bounced and moved higher. And again, how do you draw the line? Not at the lowest point, but between the peaks and the bodies, and extend it. And you see, in this case, it would look like this. Of course, before that, you could also take the line and start drawing it from here, and then the angle change. As long as you have 3 touches, the line is powerful. Remember, you won't stay on this time frame. You just want to find 3 touches and go to the lower time frames, figuring out what's going on. Yeah, but all in all, this is over. This happened already. Important for you is the line that has the most touches and is still very, very accurate right now. So what you do, this is the line you want to use. Even if you take it now from down here, you will see you still get your 3 touches, right? So it doesn't really matter. You just need more or less to understand what's going on. And this is the higher time frame. This is the highest time frame, actually, the weekly chart. Just by drawing this line, you know more or less where the price is likely to bounce. Not by the pip always, but you get an idea. And that's why this line on the weekly chart with your 3 touches or more is so important. Okay? Everybody okay so far? 3 touches or more on support. It's an uptrend, higher highs, higher lows. Okay? Sorry for that if you have trouble with audio. As I said, I'm recording this, so don't worry about it. Perfect. So that's all you need right now. If you go back, sorry, if you not go back, sorry, you see it right here. You don't have to go back, actually. If you look at this point, which was what? Still in November, December 2013, like half a year ago. That was the highest point, almost the 175 area, right? Now what you see, the price moved down, it ranged, it hit the line or went close to this line, and then it reached this area again, the 175 area. So for you, do you think that's an important thing to know? Yes, no? Yeah, it's very, very important. It will be very, very important in a few minutes. So just remember this area. I draw a horizontal line because this is the highest point in past, and then the price retraced and it came back up, finding this area. So it will become very, very important very, very soon. That's the first thing you want to do. The weekly chart, looking for trend change, and if you have the break of the power of a powerful weekly line, you want to look for reasons to trade. Okay? Now let me switch to the next time frame. If you do this, that's the weekly chart. You have your lines ready. You figured out if you have a trend or range. What's the next step we do? I'm asking, of course, members that are watching right now. What's the next thing? What's the next lower time frame? Exactly right. It's the daily chart. You go from the weekly chart to the daily chart. There we go. I think if you maximize the window, you should be able to see the whole chart. And on the daily chart, the good thing is you will find the lows that you also had on your weekly chart. You will find these lows, and you will be able to connect to draw your trend line, the one you had on the weekly, again, but in more detail. So it's the same line, but just with more detail, especially when you use MT4. You know, MT4 when you change time frames, the line doesn't really stay there. It's not that great. So you do it on the daily chart again. What I'll do, I want my 3-4 touches, and I have them. I could even start it from down here, but it doesn't really matter. I have enough touches there. Yeah? I had a line like this before, and then the angle changed. I have still my 3 lines by drawing the line like this. I also have horizontal support and resistance. So look at this. This here is our high from December 13 and 14 actually, right? These are the highs. And that's where the price is right now. Before that, we also had horizontal resistance and support in other areas. So this is the resistance here. Before, if you look at it, we had a lot of resistance also in this area. Why in this area? Because we have the most touches in this area. 1, 2, 3, 4, 5, 6, or count it as 1 if you like. It's because in the same area. Okay, and when you have that, and you see every time when the price is reaching this area, even after a big move down here, if it's coming back and it's touching here and always bouncing in this area 1, 2, 3 after the 3rd time, you know that this, even after the 2nd time, it's kind of a double top, right? You know that this area is major resistance. Do you agree with that, everybody? Does everybody agree with that so far? This is classic analysis. There's nothing fancy. Simple stuff, right? Okay, so 1, 2, 3, 4 touches, 5, 6, and what we know then at that point is like, okay, every time, yes, it's an uptrend. Everybody agrees with that, but that does not mean that the price cannot range in between, right? Yeah, it's a powerful trend, but still on lower time frames we can have a range even if we have a powerful trend. In this case, now draw your horizontal support. Look at this, we have a lot of touches down here, and if you go a little bit higher, we have also a lot of touches in this area. Previous resistance acting as support, again here and here and here. And look at this area. Why is that so important down here? Because your trend line, which is also coming from the weekly chart, not only from the daily, right? And the horizontal line, they are both ending up in this area. And as you can see, price comes back down. This area has proven to be also powerful support. Yes, of course, you have also support down here where you have touches. But most touches right now are at that point here in this area. You have just more touches in this area. So when the price comes back and it hits this area of support, now you have a trend line and horizontal support. What happens? The price does what in this area? Everybody please, so I'm sure that we are on the same page. What happens down here? Can I have 2 million answers? Or not only 2 or 3? Just to make sure we all understand. Exactly right. The price is bouncing again, and it's a very powerful move. As you can see, the price moves up, it retraces back, and it creates again a 1, 2, 3. Can everybody see that? Okay, So if you draw a trend line, you need 3 touches to make sure, you know, like this. You could say, look, it's a daily chart, but I have 1, 2, 3, 4 touches. It's going down. And then the price breaks, creates a higher point on the chart, it comes back. This line is acting as support, coming from the daily and the weekly chart. And what happens? It's bouncing again and moves higher. At that point, you will say, hey, I have a range, and this area here is major resistance. So could it not be that the price bounces again, moves back down to here, as it did a million times before? Of course. And that's why a trade on this time frame on the daily chart at that point, even knowing that you have a lot of support, the main trend is up, you have trend lines, horizontal trend lines and classic trend lines, and you have a 1, 2, 3, even knowing that this would be an aggressive entry on a daily chart. Okay, now if you know what you're doing, it's okay, as long as you know and understand what you're looking at. When you look back from the weekly chart, you'll see this here where the price bounced, you know, it's because this is the extension from down here. And you see what happened. The price was actually ranging, like it was waiting for this. The price wanted to actually come down and find this area. And if you do your top-down approach and your analysis correctly, and you start understanding the markets, then you will see that this 1, 2, 3 here could be different than everything else in between, because that's the area where the price found your major support line and of course the horizontal support combination. Everybody okay so far? I know I make you writing a lot, yeses and no's, but that's, I think, the best way. Perfect. So now you start understanding that this makes sense, and if you would trade this aggressively, it's okay, as long as you know what you're doing. Okay, now if you want to be more conservative as a trader, what you do, you wait for the next 1, 2, 3, because now you don't only have a higher high, price breaking horizontal resistance, and a higher low, price retreating back exactly to the 36, but you have this set up also over your horizontal line. Yeah, and this could make it very, very powerful. Yeah. Okay so far? Perfect. Now, how do we enter on daily charts? It's very, very simple, and it's the basic swing Spartan system rule, I would say. Okay, so what you do actually is, after doing your homework, after finding out where your support and resistance is, and of course having a little bit of experience, you look for your trend line break. In this case, it's a small trend because it's in the range, but you know the main trend is up. You wait for the break of the line, the higher high and the higher low. You wait for the 2 to 3 line break. You want to see this candle. Let me zoom in. Actually opening low if possible and closing high, and closing over this line. This is 0.1, 0.2, 0.3, and that's why we call this line. How do we call this line from 0.2 to 0.3? Does anybody remember? Anybody? Exactly right. That's our 2 to 3 line. I don't know another name for it. Yeah, that makes just sense. So it's 0.2 to 0.3. That's the 2 to 3 line. And if the candle closes over the 2 to 3 line, and this also changing the color ideally, it indicates the power of the buyers. That's when you have a daily setup. So this is a signal, a long signal. Okay, now you will get a lot of signals. If you look at 1 2 3s, you will find 1 2 3s all over the place. Important is that you find the 1 2 3s at the correct, in the correct area, and you do your top-down approach. In other words, you do your homework first, right? Otherwise, of course, you will find 1 2 3s all over the place on all time frames. But it's not smart to just trade 1 2 3s without doing a top-down approach, without knowing your targets. Okay, so afterwards, what happens? Price moves higher. Is your entry, and it moves lower again, just to find the 36 EMA. Now up here, this is your area of major resistance. Why? Because you have your high from December 2013 here, correct? And what do you expect when the price is reaching major resistance? You expect the price to retrace, to take a breather. Yeah, sometimes it's taking a breather without being in a major support or resistance area, but mostly if it's reaching major resistance, and especially after a bigger move, you can expect a retracement. You can expect the market to breathe. Okay, and these are the areas that we are going to talk about very, very soon, because the retracements are the areas we are very interested in, as well as, of course, the entries, the main trend. Okay, let me get rid of the horizontal lines so you know what's going on. So let's assume you traded here. 1 2 3. So according to the basic rules, you have done your top-down approach. You know this is major support. You have a trend line break. Yes, it's in the range, but you know what you're doing, as I said before, and you take this trade. Where would you put your stop to protect this position? This is a trade on a daily chart, and we are only covering this system today. It's a swing trading system because we don't have much time to go over everything we do, right? We cannot cover bounce trading or aggressive trading, but this is really enough to understand, to get the point and really understand what we are trying to do here. So where would you put your stop on this chart? Any ideas? I'm also asking, of course, members that are with me for a while, and they know for sure. Exactly, right? Under 0.3, which is under here. And if you measure, you'd say, hey, this is 170 points. Is that not too much? Forget the pips. Yeah, this is a basic advice for everybody. Just think in terms of percentage right now, especially when you start out. The pips will be very important when you know what you're doing. Right now, when you start out, it's probably better to think in terms of percentage. Yeah, when you trade, you invest. It's your personal business, your personal home business. You trade, you want to grow your accounts, you want to make money. So when you trade, Andrew said it here, trade with 1% or less, especially at the beginning when you start growing your account, right? Why? Because the 1 2 3, as I said, is just the 1 2 3 you can find everywhere. You can find on a 1 minute chart. Okay, on the higher time frames, you get less noise, and it can be very, very powerful if you know what you're doing. So when you do this, you say, okay, I'm growing my account. I want to grow it, so I risk only 1%. I slowly grow the account. I'm getting good at it. Make profits. I'm not sure, like let's say 20-30% at some point. If you have patience and you have a profit of 20-30%, you can then start increasing risk a little bit, like saying, okay, I risk now 2% because I know what I'm doing. It just looks good. Okay, so what's going on here? 170 or 160 has 70 pips stop in this case for sure, which would be 1%, and if you're good at it, 2%. Yeah, just the basics. That means you place your stop below here and you're trying to make 170 pips. So up here, somewhere in this area, it's the first lot is out. Why do I say the first lot? Because what we do, we split positions into multiple parts, right? We are not just opening one trade. We say, okay, we open a position and split the position ideally into 3 parts. We take incremental profits and leave one lot running in case the price wants to go up forever. Yeah, okay? Ideally, that's what you want. It won't happen every day, of course not, but that's what you want to focus on. You focus on your success, on profits, and not on losses. Yeah, you will get losing trades, of course, but it doesn't matter. You just focus on what is good. And I will explain, I saw somebody writing about this. I will explain this part very, very soon. That's why we do this here today, okay? Perfect, 170 pips stop, you make 170 pips. So with a second lot, you're going for about twice that much, which would be like 300 something, right? Correct? 300 something. If you have 170 pips stop, so actually it would be somewhere up here, 350 pips. But what do you know? You know that this area 170 something, 75, sorry, something is major resistance. This is a general rule that says, okay, if I have a stop of 170 pips, I'm trying to make 170 and 340. Yeah. But when you measure and say, look, the major resistance is only 280 pips away, then this is okay. Yeah, the general rule says yes, twice the stop. But you are not stupid. If you see major resistance, it's close to 2 times the stop, then it's okay to target this area for the second part of the trade. Does it make sense? Yeah, we are not blindly like lemmings just saying, okay, this is math. 50 pips stop are going to for 50 and 100. If the resistance is at 80 pips, you take it at 80. If it is at 120, you can even go for more. Yeah? So general stuff, but it's very important that you understand these basics to get the mindset right. Okay, so we assume you take out one lot here, and in this area the second lot. Now you have one lot running, one big lot. What would you do with this? Any ideas? There's 1/3 running. 2 parts are already out. So right now with 170 pips stop and taking out 2 parts of the trade, you create the win-win scenario. That means you cannot lose anymore on this trade. You let it run because what you expect is the price moving higher. Why do you expect this, please? Why do you expect the price to move higher? Any ideas? You have a lot of good, yeah, you have good support, that's okay, but because of the main trend. The main trend, boys and girls, is the king. You know, it's so important that you always look at this and say, okay, what is the main trend saying? It could be up 5,000 pips as long as it's moving higher in the end, as long as your weekly and daily support line is strong. That is what you are focusing on. Okay, the long trades, not the shorts. Very, very important. Okay. Now, okay, perfect. The price retraced. It bounced again because what you can do now, yes, you have your weekly line, but you can zoom in with your trend line a little bit by changing the angle. You know that this is the weekly line, great, you leave it. It's not that it's like not worth anything. It's very powerful, but you have also a line like here, 1, 2, 3 touches, the extension here 4 touches, right? And what we also do is bounce trading. Like there are ways to immediately, we have ways to immediately go along and quickly create win-win scenarios. This is not for today, I'm just saying. So that's why a line on this time frame is also very, very important, right? And of course this one, this whole area here, from here on the daily and the weekly, this whole area is still major support. And that is why it's so important you watch out closely. You look out and watch out here for things that happen in this area. Now, are we all okay so far? Because what we did now is we covered the basic Spartan system, entering on higher time frames, using the daily chart, drawing trend lines, looking for entries, having targets. Okay, exactly. And what you said is, okay, you want the price to create higher points because it's a major uptrend. But yes, there are two things you can do here. One is, let me get rid of this line. We don't want too many on the charts. This whole area support, you know that. This is just the one on the daily chart. You can of course trail your stop below the line like this, and then in this area like that, and then the price would stop out the last position with about break even, or about like 60 pips profits. All in all, a great trade, wonderful, everything perfect. Now you look for the next trade. Yeah, this is one thing you can do, but there's another thing. And remember our 3 steps. What we did here, let's go back to the steps. I have them right here. We did this, right? Step 1. And we did also step 2. If the signal is triggered, you don't hesitate. You trade by splitting your positions into multiple parts. As I said, we like to split into 3 parts. We never expose the account to more than 1 or 2%. Okay, the goal is to stay in the trade as long as possible, especially when you write the trend. If the price goes your way, you look always for bigger targets and trail your stop according to the system rules. That is what we did so far. Do you all agree with that? We did that, right? Yes, no? Perfect. Okay, great. So what we do now, we go to step 3. And again, let me read it again. It's not boring, really, it's important. The markets never move in one direction without taking a breather, pullback or retracement. You take advantage of these pullbacks on lower time frames by locking in profits, which is hedging. You will make incremental profits on the pullbacks and leave the main trend positions running according to the trade management rules. Now repeat these 3 steps again and again. And that is what we are going to do now. Okay? What I want to ask you, Jeff just pointed it out here on Skype. He says, hey, the guys are going to, some will explode probably. Do you want us to take a 10-minute break so you can digest everything, and then we switch over to step 3? Or do you want me to continue immediately? Donut time, coffee please. Yes, no. Okay, some want, some not. So okay, let's say 5 minutes then. Okay, let's do a 5-minute break, because we have not only to explain this, but I also want to show you the live examples, and this will probably take another hour. Yeah, I said 1.5 hours, but we always usually do a little bit more you probably have also questions. Okay, so we do 5 minutes, a tiny 5-minute break. See you in 5 minutes. Okay, is everybody back? Or am I too early? Okay, great. So let's go over step 3 right now. Hope you're ready. What we do, we just say, yes, this was the aggressive way to do it because of your horizontal resistance, everything. This was the setup over horizontal resistance. But okay, it broke this area of resistance, right? But you have also another area of resistance up here. And you know, when you look at this setup, you'll say, hey, you can say, okay, this is a daily setup again, right? I have my entry here, my stop is here. Now the good thing is the stop is only about 100 pips in this case. Yeah, so 100, maybe 110, but about 100 pips. So by doing your top-down approach and seeing the setup over here, also getting the signal, the first thing you do when you see an entry, you have a retracement back to the 36, you have at that point your 3 touches on support, the main trend is going up, everything is just pointing your way. Okay, so that really tells you, like the chart is telling you really that you want to trade. Yeah, there are ways to trade here on lower time frames, of course, yes, but we are going to cover the higher time frames today. So you find an entry here. It's not really that far from this entry. You see, you know, it's like 100 pips, and on the daily chart it's not much. But forget the previous entry, just focus on this one now. You have an entry with a stop of about 100 points. So if you have a stop of about 100 points, you place the stop about 20-30 pips below your 0.3 on the 1, 2, 3, right? If it's an uptrend. And if you have an existing trend line with 3 touches, you place it also below there, just to make sure you don't have, I don't know, some noise here, something weird, a small range, and make sure you don't get kicked out. So if the price really wants to move higher, this is the safe place for your stop. Having a stop of 100 pips, you need to measure the distance between the entry and your resistance area, and that would be the 175 area, and this is about 200 to 220 pips or something, and that means more or less twice the stop. Correct so far? Everybody agrees? So when you split a position into 3 parts, you say, okay, I have a stop of 100 pips, my target is 100 and 200 more or less. That means if the price reaches 175, which is major resistance, I already create a win-win scenario. Again, like I did here. Because I took out 2 lots, I have 1 running, my bonus lot, that's how we call it, right? Because we want to make sure if the trend moves is powerful and moves higher, that we stay in as long as possible. If it doesn't really matter much. Even if you go on vacation or you just forget or whatever, if the price goes down and hits your stop, you still make profits because you took out 2 parts. 100 and 200 pips, have a stop of 100. The third part would hit the stop of 100. You keep the 200. Okay so far? This is still 1 position split into 3 parts. You made your calculations, you know targets are far enough, so it's smart to still trade on this high time frame. And now you say if the price moves higher, great, I make more. If not, then if I just leave the stop where it is, it's over. This is the classic way to do that. But now we have part 3, step 3, sorry, on our 3-step formula, and that says try to take advantage of retracements. Meaning, you enter here, right? At that point, you are 230 pips in profit. You see that, you know, okay, it's a win-win scenario, but just by seeing the 200 plus pips and thinking about a possible retracement, because you expect this because of resistance, it doesn't feel good when you say, okay, it will go probably back down to where it came from because of major resistance. That means at that point that I give all my profits back. Even if it's only one lot left, you would give the 200 pips back to the markets theoretically, even if you leave the position out open, and even if that goes up 1,000 pips. At that point in time, here or here, at that point in time, especially here when it's reaching major resistance, it doesn't really feel good, because you say, man, I did everything according to the rules. Yes, I created my win-win scenario, but it's not really that perfect that I give theoretically all the profits back, because it could also just go against me and hit my stop, and then I would not only lose the 200 pips I was making, I even lost 100. Yeah. In the end, you still made 200 pips, but just by thinking about it, you could have made another 200. So more percentage profits. Does it make sense so far? Great. So what we want to do, and I'll tell you again, that is something that many students do already, and also colleagues of mine, friends that trade for many, many years, they all are into swing trading or position trading, but whenever they get the chance, and I do the same thing, they trade against the main trend if it makes sense to, as we like to say, milk the markets on the retracement. Yeah? Because we know the market always creates 1, 2, 3s. The market is always breathing in, breathing out, breathing in, breathing out. So why not taking advantage of this? And if the price moves higher, you make profits on both sides. And even if it doesn't, you still make a lot of profits. Okay, why? Because that money sucks. Yeah, there we go. Why? Because we hedge up a position, right? And we make sure we make more if possible. Now, to make that clear, if you are located in the USA, for instance, or in Canada, and I don't know if the other countries, for some weird reason I really don't understand, they don't allow hedging on their trading accounts. Okay, that means if you have a US account, or I don't know, whatever broker you use, they don't let you open a short and a long at the same time. I mean, like you have a long running and suddenly you want to trade short, they would not let you. So, or what they would do, if you go short, it would close the long. Okay, that means you cannot leave in the remaining position. So what you do is very simple. You go find a broker that allows that. Okay, that means you choose a broker outside of the country, or you just open, very simply, go to your broker. If you like your broker, you just tell them, hey, open a sub account. It doesn't cost anything, and what you do, you just take, I don't know, 30% of your money out of the original account, transfer it to the sub account, and then you hedge from there. It's exactly the same thing. It's a 1 hour thing. Yeah? You just call, or not even that, a 5-minute procedure, and they open it for you, and then you can hedge. I don't know why they make it so complicated in the USA, but that's, I think, how it is. And if you're not okay with it, then you open an account somewhere outside the country. I don't think it's illegal, right? And then you do it from there. But that's it. And I know many people and students that did that already, so not a problem at all. Perfect. So let's continue. First of all, some people would say, hey, why should I hedge something up? What's What's the reason, you know? Why not just getting rid of the longs at that point and taking the shorts? And if the longs appear again, then I get try longs. Yeah. I'll tell you why, because when you have a powerful trend running, okay, you want to make sure you stay in as long as possible with this position without having to look all the time for new entries. And when you hedge up a position, that's actually what you do, because it could also happen that, look, you have this one red candle, it looks on this time frame like it will retrace, right? But then in the end it decides the next day to move up again. If you closed the long position, it's over for you. You now have to wait for actually a new setup to start making profits again. Yeah? Compared to if you hedge up a position at a smart area, which I will explain what you do, you lock in the profits, you make profits also if the price really retraces more, and you get rid of the hedged position if the trends really continues. Okay, and if that doesn't happen, like if you hedge up a position and it goes immediately your way again, you just get rid of the hedged up position, you keep the swing trend following position running, okay? And then you make a small loss maybe, but this one will make much more overall over the long run. So it's very, very smart to do that if you know how to do it correctly. Okay, let's do it right now. This is the example for us. Market is going up. You are long. And I choose this example, as I said, because we have people trading this live, and I will share the charts with you soon. We got the signal. Yes, it's only 200 pips to major resistance from last year, which is very, very important. But because you have big enough targets and you know how to hedge, you don't care much. You know what you're doing. So price is moving up. It's hitting this area. If the price penetrates that line and moves higher, great. You don't have to do anything. You just stay in and have fun. But if you see there's weakness, meaning you have, this is a daily candle, the next candle the price does not move higher, and then the third day in this example you see the price cannot move higher, that means something is going on here. This is major resistance, so we might get our retracement. You also look at the previous 1 to 3s. You can measure and say, hey, this moved up 300 points. This moved up 300 points. This moved up 300 something points from down here. Okay, so the previous 2 times after 300 pips, this retraced. Now it moved up another 300 plus pips, and it also found major resistance. So there's a big chance of a retracement, right? Because the chart already told us that this was important, and it wanted to retrace after 300 pips 2 times. And believe it or not, that's if the trend is strong, that's what is happening usually. Yeah? More or less in this area, in combination with horizontal support and resistance, the price will retrace. Okay, price moved up 300 points, and now you say, okay, I have one position running, one lot is open, but I don't want to give it all back, and I'm not sure that will really create higher points because of major resistance. Maybe it goes against me, and then I give everything back and I'm also losing some. All in all, I make profits, but again, I could have made more. That's always what you have in mind, even if you don't like it. That's how we think, and that is common sense, and that's okay. So what do? You cannot just go short just because you see a red candle, as we said before. You need to filter it out. You need to find signs for retracement, and you want to see a confirmation. You want to know making sure that the price is really trying to retrace. So what do you think we could do? And this is, as I said, the hedging part. That is what it's all about today. Any ideas? There are many people in the room, many. So just think about it for a few seconds. Yeah, it makes sense, right? What did we do before? We had the filter, we had the higher time frames, and then we went to the lower time frames to look for entries in the direction of the main trend. Now we want to hedge it up. We want to make some profits against the main trend, and against the main trend is never as powerful as trading with the main trend. So we don't do that on the same time frame. Exactly what we do, we switch to the lower time frames to look for some signs there. And what would be the next time frame for us? What do you think? We actually go down to 2 lower time frames. It depends on what your trading plan says at that point. There we go, right? We do not use the 5 or 15 minute chart for it. We use the 4 hourly or 1 hourly chart for this. Okay? There are ways to trade on 5 minute charts, yes, but when we trade on daily charts, the basic rule to hedge up is the lower time frame, and that would be the 4 hourly, 1 hourly chart. Okay, we cannot cover the lower time frames today. It would be too much, really, believe me. So at that point, let me get rid of the lines. We only keep the support line. This is our resistance area, the 130 something area. That's where it bounced in the end. And now we switch to the 4 hourly chart. Let me zoom in. And that's how that looks. Here's your support line. You see the bounces on this line. This is the highest point. And if you look at it, this is really a big steep move up, right? And then what do you see just on this 4 hourly chart? Your 36 EMA is support, even on the 4 hourly chart. That means that if the price goes down to here, bounces on it, it moves higher. On the 4 hourly chart, that means you cannot do anything, you wouldn't hedge up anything, because the price would create still higher points on the chart, right? Like higher lows, sorry. So on the 4 hourly chart, what would you do? How would you hedge this up? Any ideas? I know I'm asking a lot of you. Just try common sense. Break up the 36. Look for the EMA crosses. Bill says, look for 1, 2, 3, trend line, bounce. Yeah. Call me. No, I won't tell you. Lower high and 1, 2, 3. Yeah, so there are 2 ways to do that. You're all right, more or less, right? So if you want to do it very conservatively, you would say, hey, I just have to wait for my 1, 2, 3 below the 36. This is usually the conservative way to do it, right? In this case, it means the 36 has to break, price has to move lower, it has to retrace back, and when it does this, in this case, it doesn't really matter if it traces to the 36 or the 12. You want to see a 1, 2, 3 against the main trend below the 36 if you want to be conservative. So if you look at this on the 4-hourly chart, and here is your break, yeah, and we don't really mind that much if you take it on the close of the candle, like for the entry or during the move, because it's a hedge trade, but you need that lower high, you need that 1, 2, 3, ideally also the close of the candle. In this example, if you look at it, look at the daily chart again. This was your entry. And Duncan said it. Yeah, you would lose some pips there, because at that point you would hedge the whole trade with 60 pips, which is not bad. It's better than at break even, right? It's at least hedged up with 60 pips. So if everything goes against you, at least you make another 60 pips. You understand what I mean? But that's why I use this example, because this is not that perfect. Yeah, sometimes price moves up 300-400 pips and then started to retrace, and then you have a big buffer of 400 pips here. In this example, you don't have that much, you have only 200, and then also you have a setup against this where you have an entry, and this is only 60 pips from your original entry. So it is still okay, because you at least hedged up 60 pips, okay? But it's not perfect, yeah? It's better than nothing, but it's not perfect. So if I would calculate my stop, it would be a 60-point stop, 60 pip stop. And what about my target? My target is still that support line, right? Because I expect the price to bounce here. So if I measure, I say, hey, this is like 70 pips. This would not cover the first and second lot. This also goes for the retracement trades. Yeah, you also want to try to cover the first and second lot if possible. Because when you hedge up a position, ideally you want to hedge it up with 3 lots, okay? Taking out the first and second to milk the markets against the main trend. With other words, to making extra profits, not only locking in the existing profits, but making extra profits. Okay? Do you understand that? Yes? No? Hedging up is great, so you cannot lose whatever you have hedged up. But opening 3 lots with the same risk of, I don't know, 0.5%, 1%, whatever you risk on the first 3 lots on the longs, would mean that if you have a big enough target, you would make more. Okay, like you would make another extra, let's say 1,740 pips if you have enough room, and if the price then reaches support and it goes back up, you have the hedged position with, I don't know, 150, 200 pips plus the 1,740. Yeah, so you have extra profits on retracement. Then you leave your hedged position, and if you get the first signs that the price wants to move higher now, you get rid of the shorts, keep the longs, and keep whatever was left with the shorts, and now you have the big profit still on the long. So it's just really, really good. But I chose this example because it's not that perfect. Yeah, so we have to think a little bit. The second one will be worse, by the way, but that's the best way to do that. So at that point, I'll say on the 4-hourly chart, no, I cannot target 70 and 140 pips. Okay, and Andrew says it, if it goes against you, you have extra loss as well. Okay, because right now it's really close to support and you don't really know. Will that go there, or is it already retraced enough? Because it did retrace 170 pips out of 200 something. Yeah. On the 4-hourly chart, the best way to do this conservatively would be just to hedge it up with one lot to make sure you make extra 60 pips in case this really goes against you. Okay? Now, you are too quick. Just have a little bit patience. Okay? This is one way you do it. The aggressive way to do this, but this comes with experience. I don't want to go into this today. We do it next week anyway. Would be you target this area with an extra lot, saying, okay, if that goes there, I take out my extra lot, 2 lots with other words, not 3, and leave the other running. Then you made 120. Then you made actually as much as, it would be like you were hedged up from up here somewhere. Yeah, you made this extra 60 pips. Okay? Okay so far? So this is the 4-hourly, okay, and this is a 1 to 3, by the way. Yeah, it is a 1 to 3 on the 4-hourly. So what you want to do to be very conservative, you would take it, knowing that's not far from support, with one lot, just to repeat, to lock in this 60 pips, better than 0, or aggressively 2 parts, taking out one in this area and leave the other one running, making an extra 60 pips. And what you would do if the price would create another 1, 2, 3 up here, going back to the 36, breaking this and moving higher, what would you have done there at that point? Any ideas? You wouldn't add the longs. You could add the longs, but not if you are new to it. What you would do here would close the shorts, because you have already a long from up here. Keep your 60 pips you made extra. Leave your longs now and let them make again profits. Okay? This is classic hedging. I know it was not that easy on the 4-hourly chart. Is everybody okay so far? It's recorded, so you can watch this again and again. I don't expect anybody to understand all this 100%, so no worries. Yeah, and I always get about 15 answers, and I have much more people in the room. But it's okay, some people are shy, don't worry. No, there was no 60 pips loss. Bill, just watch the video later on, okay? I will have another example for this. Yeah, it was a 60 pip profit extra, and at that point, we are not here yet. We are going to discuss it now, okay? At that point, if you would have, let's say, another 1, 2, 3 up here, it would be more profits. Now, that went down, and I'm going to explain now. Okay, so before I go there, we forgot the floor time frame. So that's the 4-hourly thing. There's another way to do this, and that would be on the 1-hourly chart to do it more aggressive. What you do at that point when you see the price is struggling there, And you know this is only 200 pips, it's not 400 or 500 pips back to support. You know, and you like the fact that this went up really steep. That is very important. This steep thing could also mean a steep retracement. What we do, we switch to the 1 hourly chart. And on the 1 hourly chart, you have again a trend line. Now close to the 36, because this price, after touching a couple of times at the 12, it also came back to the 36. And if you look at the at the 1 hourly chart, you will notice that the price didn't move 1 pip higher than this resistance area, 175.35. So it really struggled here, came back. At that point, it still looks long because you still have higher highs and higher lows. The price moves up, but it cannot create a higher a higher high, right? It creates higher lows. It's still over the 36. We don't like that. And then it's not easy to spot in this example. Really, it isn't. You have two ways, sorry for that, to do this. First one is a very aggressive entry, meaning the price penetrates the 36 a little bit, but it doesn't mean much because it did that before. It then retraces back, created another higher, sorry, this is the lower high, right? And another lower high at that point, and then it breaks the 36, and this candle is closing below the 36. Yeah, it opens high, it's closing lower. It also broke that line. The price created lower highs before, and it failed to move higher coming from here, from the daily and even the weekly chart. So a very aggressive way to hedge this up would be immediately after the lower high and the trend line break, when the price close below the 36, and this actually comes with a crossover. We don't even have the crossover yet. Yeah, so that is why I say it's aggressive, or aggressive sounds bad, we could call it early. Yeah, an early entry. You also have resistance here with 1, 2, 3, 4 touches. So this is telling you the price cannot move higher, penetrates the 36, retraces back, but does not really move up to where it came from. It immediately moves down the next hour and closes below the 36. Yeah, so we have a lower point on the chart at that point after the break. So this would be the early entry to hedge up an existing trade, and that would be close to your 200 pips at that point. And if you hedge it up here, let me go back to the daily chart. Up here, okay, you have now 170 pips. And when you calculate this to down here, this is 170 pips, okay? But on the 1 hourly chart, you have only a stop now of about 30 pips. So is that going to cover the first and the second lot to target 170? It all depends, Andrew says, whether you're asleep or watching in action. It all depends actually on your trading plan. So if you have your hours set and you know what times you trade, then you will look for this, okay? And if you cannot be there, you can set alerts. And if it's at your night, you will miss it and you just don't take it. You will wait for the next opportunity, which would be the higher time frame, or another 1 to 3 on the lower time frame, okay? Nobody expects you to catch each and every trade. Okay, so what happens now? You have your 30 pip stop. This is going down, and you have a target of 170. So easily you can open 3 lots, make 30 and 60 pips on average, and leave the last lot running. Now you have a hedged position of 170 pips, and the market made another 100 pips, okay, more or less, with your 30 and 60. Another way, like you miss this, you wait for the next 1, 2, 3, okay. Now when you wait for 1, 2, 3s to hedge, ideally you want the retracement back to the 36, but if the price is volatile, as long as you have a 1, 2, 3 below your trend line break, you are okay to go, even if it doesn't look perfect on the chart, right? But we have so many filters there we can use. I just give you one example. This one, retracement to the 12th, entry here. This one a little bit lower when it almost retraced to the 36 and then breaks or so on the break. Even if you didn't catch it and you have to wait for the close of the candle, if the stop in this case is 70 pips, your target is 90, it's still like, you know, you have to be more aggressive there and say, okay, it doesn't really matter, I will take then my extra lot, I take only one extra lot and target this area, yeah, or one with 70 and the second with about 90. Ideally you want to look for an early entry, or you want to take the entry on the break if it's really volatile and you are watching. Sorry for that. It would be great if you can get a retracement to the 36. If you don't, it's okay. Now you get one chance, you get another chance, you get two actually. You get one here with a small stop of about probably 30 pips or 40. Target is big enough. The first one. Now if the first one, if you can't catch the first one on the 1 hourly, okay, and the retracement is only to the 12th, then for sure, if it's the second you are looking for, at that point you really want to wait for the retracement to the 36, because a retracement to the 12th could not, maybe is not powerful enough and it will move lower. Okay, so wait for the retracement if you don't catch the first retracement to the 12th. If you don't get it, wait for the second one on the 1 hourly chart. And if you miss this one, you wait for the 4 hourly 1, 2, 3, as we discussed it before. Just give you some scenarios here. And then if you trade one lot, before I forget, if you have hedged it up with one lot only, then you don't need any stops, because you have a long and a short at the same time. The price could move 1,000,000 pips, you will be hedged up anyway. Now if you hedge up with 2 lots or 3 lots, you have to use a stop, of course, right? Makes sense. Perfect. So in this example where the price retraced to the 36, you have a stop of about 30 points. You would have a stop of about 30 points. Okay, you don't need it if you had only one lot anyway. Now if you have more, you have also to draw your trend lines. Don't forget that, right? Sometimes here you get this setup on the 4 hourly close to the one on the 1 hourly. It's more or less the same. You get another one later on. Yeah, some people like to use the 4 hourly 1, 2, 3, or they combine it, and if they have a 4 and 1 hourly in the same area, they like to place the stop over the highs on the 4 hourly just to make sure. Yeah, or they don't use a stop at all, of course, if it's a hedged position with one lot only. So let's don't overcomplicate it. As I think I said already, too many things, too many scenarios. Let's keep it simple. The first one, the first setup is the one you're looking for on the lower time frame. If you miss it out, watch for the 4 hourly 1, 2, 3. Okay, and if the target is big enough, you know what to do. Ideally 3 lots if target is big enough. If not, 1 lot. Okay, so far? Now if you don't get any reversal signals, let's say you took the 1 hourly or 4 hourly short and you have the long, price is going down, it's bouncing, it's not confirming the longs. Yeah, it's not really moving higher. Now it's going down. you still have two positions running. You have the long from here, you have the short from here. Price breaks your daily line, and it's also finding the weekly support line in this area. Remember, it's the same area here, more or less. Now what? Look what happened here. Price moved down. You had an entry along here. You might have a short from here or here. Let's put the average price. So right now you hedged up with about 100 pips. And this moved lower. It doesn't really matter where it goes right now, right? Because you hedged up with 100 pips. So the worst scenario, you keep 100 pips. Okay so far? Everybody okay so far? You have a hedged position, you don't have a direction anymore, and you have 100 pips profits because you hedged up. If you didn't, let's say you would not have hedged, the position right now, and it would be a loss, right? Or not a loss, it would be at break even because your stop is still much lower. So you would have lost like 200 pips in theory. Now, this created 1, 2, 3 and moved lower. Isn't that a 1, 2, 3? Is it not below the line? So is there any scenario for here? Any ideas? Could you have done something there? You are already short and you are already long. You're long from here, you're short from here. I know it's a lot of information. I'm sorry, but it will be much easier if you watch the video 1 or 2 times later on. So we have add an extra lot. No, not needed actually. Close the longs, get rid of the longs. Some people say exit the longs. Yeah, would not be wrong because the price created 1, 2, 3. You could say, hey, I just get rid of the long, I keep my short now, and the long made me 100 pips there anyway. And if you melt the market in between by taking incremental profits, it's okay. Now you have also a trend line here. 1 touch, 2 touch, 3 touches. As long as the price stays there, it's okay. But of course, that is really up to you what you want to do. The one scenario says get rid of the longs, leave the short. The other would say, okay, let's check the daily chart. The daily chart, we have the lower high, could mean that this really breaks down, so it makes sense after the trend line break to leave the shorts running. And if they are going, great. If that's going short, perfect. Then your shorts will make profits now. In case price goes back against you, you made already incremental profits from the 2 lots. And even if that doesn't work out and you have to manage it, you hedge it up with 100 pips. Worst scenario would be a break even. You're giving back the 100, okay, but you made already 30 and 60 or 40 and 80, whatever, over 100 pips with the first and second lot. Yeah, and this, as I said, is a difficult example because we don't have a big distance between the highest point and the retracement. So do we get the basics here? This was one example, and this is how I do these things. I would have done also that, but let me share with you what Jan did. Jan is practicing this for a couple of months with hedging, and he's taking action, and that's the main thing. You want to take action, you want to make sure you practice things. Yeah. So let me see. I have the charts ready here. Let's see if you can see that. So this is, it says, you can all see it, GBP JPY. It's a daily chart, right? Everybody can see the chart, the image here. Okay, great. So that was the 1, 2, 3 Jean took. Here's his horizontal line. As we did it, there was also a trend line he drew, and here's his support line. It's a 1, 2, 3, and he took it on the daily chart. Okay, and this is actually also his trading journal. So he put some comments on it and remembers what he was doing, and that is, especially the new traders, that's what you want to do. You want to have a trading journal. So it says, first, I targeted daily setup, 100 pips stop loss. Days later, first and second part got hit, 100 and 200 pips, bonus lot running. Exactly what we said before, right? He just used the classic rules, took the entry and targeted the 175 area, whatever, target 1 and target 2. So because price moved far away from major daily support, start looking for reverse setups to hedge my long bonus lot and milk the market on the retracement. There we go. Let's switch. Can you all see that? Let me zoom in a little bit. So it's his buy position there, and here's the entry, here's the stop, right? Okay, the second chart, it's the 1 hourly chart. So what he did, he drew the line like this, and he said, he didn't do the aggressive early entry up here. He waited and said, no, I'll wait for this. It looks powerful. I choose the 1 hourly 1, 2, 3. Data price gave me an opportunity to hedge up my long bonus part and to target daily support. I went short with 3 parts as per rules with 30 pips stop loss. Okay, so let me see what happened here. This is the hedge trade. So here you can see the long, and here you can see the short. Yeah, I think everybody can see this. Target 1 in target 2 and the stop. So switch to the next chart. Price retraced and then it moved lower, and it says 2 days later. Here you see the higher time frame, he had it in there. 2 days later price hit 0.2 and 0.1 and 0.2 with 36 and 72 pips. Bonus short started to run. Win-win scenario with 2 bonus parts running. Okay, so he has this long and he has the short. Let me do it like this. Here's this entry. Can everybody see it? So it's exactly the example we used before, right? Exactly according to the rules. Okay, that's why it's so nice that we have this, and I wanted to show this to you. The entry was up here. It was the 1 hourly chart, right? The 1 hourly chart. And then, what is this? Okay, because of the confirmation daily lower highs, major daily trend line and EMA 36 break, and the 4 hourly, 1 hourly, 1 to 3, I closed my bonus long lot. So he closed now the lot, and he didn't give it all back because he hedged up here. It took incremental profits. Price created a lower high. Now it's breaking this line and moving lower. And if he gets lucky, this will go down a lot, and he will leave in this last lot to target major support now. Okay, so not only milking the markets, but actually already being in a short trade in case this trend really wants to change. So he does not even have to look for new entries now. See the power? Can everybody see the power in this? If you get the how do you say, the hang of it? Yeah, it's important. As I said, I don't expect anybody to understand it 100% right now, because there are many ways to do it, but we have to go for the some basic setups here to make it easy for you. Okay, perfect. Here you can see also the 1 hourly chart. He saw that on the 1 hourly chart and on the 4 hourly, and that was the reason he got rid of the longs, because the shorts triggered setups after the trend line break. So common sense, according to the rules, that's what you want to do. And again, well done to Jean, he's really good at that. And not only him, there are many others that are doing it. Kathy, you are in the room. I don't know if you listen now. Do you still have your USD CAD? Did you hedge it up, or is it not hedged up right now? Because I know you hedged it up in between a couple of times. It's not hedged right now. Okay, it doesn't matter. Okay, well done. Perfect. I think that's it. Let me see if, yeah, I don't have other charts here. So this was an example, a live example. It's still running. And Jean, you hedged, so you got rid of the longs, I think just a little bit before we started the session, right? When this setup appeared on the 1 hourly chart, a couple of hours before. Okay, so well done. Great. Now, I'll give you another example, and I will do this really quickly because I know it was already a lot for you today. And then I will, you know, leave you rest a little bit. We will choose the example that Kathy took. Also Gail, by the way, sorry, before I don't want to forget, Gail and Louis and Leonard and other people doing these hedging already with a lot of success. So well done to all of you. Of course, it's just that most people in the room are probably very, very new to this, so it's much to digest right now, but I'll give you also a solution later on, don't worry. Here we go. This is the USD CAD weekly chart, and I make it quick because now you know the basics. It's a simple analysis. Weekly chart, you have horizontal support and resistance in this area. You also have kind of a trend line break. You have a crossover. You have a 1, 2, 3, 1, 2, 3, and then a 2 to 3 line break. Price is moving higher. You have higher highs, higher lows all the time, and the price moved really far. It moved up and up and up and up. It moved away from the 36, and then it started having some issues up here. So it found major support. It spiked. It was a false break. Price came back, and when the price comes back, what do we expect? We expect the price to retrace back to, please, a million answers. We're looking for the price to retrace back to, who is listening, just to check. Exactly right, to support to the 36 EMA. And why? Because the price did that many times before on this chart, and we can expect it to do that again. And that's exactly what the price did. It retraced back to the 36, and it even retraced lower, trying to find the extension of this trend line. That's why higher time frame trend lines are so powerful. And let's switch to the lower time frame. We know it was an uptrend for a long time, and we just imagine we are up there, and that's where the story started with some of you that tried the hedge positions and also the short trades. So we have kind of a range in this uptrend, right? You have daily trend lines that you see the angle of this trend line changes here because the price moves over the 36. You get a lot of daily 1 2 3s, and you can just look at it. We don't need to overanalyze it. It's just so easy to spot when the price creates higher highs and higher lows and come back to support. The power of that, even in a range like this, the main trend is the king, and as long as the price bounces, it moves higher, you focus on the main trend. So this moved up a lot from down here where we had another trend change and another 1 2 3. This moved up about 800 points before it started to lose steam, and then the trend line is changing, the angle of the line is changing. You saw you have a little bit at some point of a range here where you have the most touches, highest point and some spikes. Okay, a range. This price is still creating higher lows on the chart. Okay, Jay, don't worry, I know it's late there. And then the price moves back up. It's a false break. We don't have a setup over here. It comes back down. What happens? It breaks the trend line. And again, it's a daily trend line. One more time. Is this a powerful trend line? Is this important to watch now that we have more than 3 touches on it? Yeah. Is this an important line? Of course it is. Yeah. The line breaks. Price creates another 1 2 3 lower high, lower low. And now we have a short 1 2 3. And this is my support line. And if I'm long, and I think Nelson and Leonard have this hedged position. Sorry, Kathy, you have the shorts, I know. Did you also have the longs? I don't recall. Sorry for that, because I see you are the only one in the room right now with the USD cat trade that I know for. So you don't have the hedge, you only have the shorts from up here. Okay? Okay, perfect. So some traders are long since down here and later on also from down here. They are long and they are also short because what they did, they followed the trend, and you can see, as I said, this is about, at some point it went up to 800 pips profit, okay, and even entering somewhere here in this area, this was at some point 600 pips. So when that happens, when the trend line breaks, it's not easy to keep that bonus lot running. That's why you want to look for hedging position. Now, you know that by looking on the weekly chart, support is really far away, and that keeps you, strong with waiting for a setup against the main trend. Also, the 36 is your support because that proved to be very powerful. Yeah. So two ways to do this again. In this scenario, I didn't even go to the 4-hourly yet because we had a big buffer of 600 pips. This is not 200 pips. And you could see that even on the daily chart, you get chances to hedge up a big, powerful, long swing trade. Okay, so far? On the daily chart with entries, stops of about 100 pips and targets about 360 points. So yes, it covers the first and second lot, and then you leave the bonus lot running. Okay, so combining these daily charts with these daily. Now you can also, of course, look for setups after the break in this area on 4-hourly charts and 1-hourly charts. I have to scroll back for that actually. And if you take a look, you'll see, there we go. The price did retrace to the 12, but it's a steep move. And as I said, you can do that. Or if you missed that, there's another opportunity there. Later on even there, but the first was this and this, then you have a stop of about 70 pips, and of course it's worth it, and you are hedged up much earlier. Like if you are in from here, not from down here, let's say from here, you're hedged up now with about 350 to 400 pips. Yeah? and in this area it's a little bit less, about 70 pips less. Okay, it's still great here or here, and then the price moves lower, and as long as the price on the daily chart, because it's a big buffer, creates lower highs and lower lows, you can stay in, you don't have to hedge up anything anymore. Yeah, now it's a win-win scenario. You made more pips, you hedged up with 300, 400 or 500 pips here, and now what are you waiting for? Let's say you have one lot running on each position. Not, you already took your profits. Right now you have one long and you have one short, because you wanted to manage this trade on the weekly chart, not even on the daily. Yeah, you can even do that. Let's just imagine you don't trail anything, right, Andrew? At that point, when you create a win-win scenario, and what you would do, if you trail your stop, yes, you can get stopped out. But if you have one position running and you see it's getting weak, the price once is kind of ranging, you have to think, do I want to hedge or do I want to get stopped out? It doesn't matter, both things are okay, but we are talking about hedging here. So if you do that, you would not let the stop, you would not trail the stop, you would leave the stop where it is and look for hedging position, right? Don't forget that. It depends on what you want to do. And this is now on the higher time frame. I'm just sharing a daily chart with a daily chart. Actually, what you would have done here after a daily 1 to 3, usually you get rid of the longs and keep the shorts. Yeah, if you're not already hedged up here, at that point you would get, if you hedged up from down here, sorry, you would get rid of your long at that point if you were to manage this on the daily chart. Only if you want to manage this on the weekly, on a much higher time frame, you would have left the long position. That's why I use this example. Yeah, don't forget that with a stop, if you want to hedge up the position, the stop stays where it is. You don't start trailing it too close. And if you start hedging up and you have one long and one short, you don't need a stop at all, because it doesn't matter where the price goes, you are hedged up. Okay, so what would you do? As I said, you would leave it in as long as the price creates low highs and lower lows. And now this is your weekly support line. And if the price breaks this weekly support line, creates a 1, 2, 3 below here, what then? Any ideas? I know it's much. It's the last example. You keep the short, and then you really get rid of the big long you have here since forever. Yeah, or you reinstate existing short. You can take also, of course, more short positions. Yeah, great. So I had another example ready, because you even can take advantage of these retracements by going to the 4-hourly chart, but we won't do it. Yeah, it will be too much. It's already too much. But that's how it works, right? That's how it works. You take the longs, price gives you a sign for shorts, you hedge it up against the main trend, and if it's bouncing and really wants to move higher, you get rid of the short, you keep the long. If it moves lower, you get rid of the longs and keep the shorts, and milk the markets before, in both directions. In the end, keep just the one that makes sense. Do you get the basics? And can you see the power of it? I ask again just to make sure. Great, perfect. So And it's okay, don't worry. As I said, it's recorded. Now, there's one more thing. I created a small, we call it like 3-step formula blueprint, where I have the rules and some examples for you on charts. I will send that to you tomorrow. Okay, then you can sorry, give me 1 second here. Okay, then you can take the video, which is 2 hours already, right, and combine it with this blueprint, with this small PDF, to get the basics, to get used to it, right? And I really have to remind you of next week's workshop. We go live with this hedging strategy with the 3-step formula next week for a whole week. We have 5 sessions doing this live, and not only on higher time frames but also on lower time frames, and also in ranging markets. So it will be a 1 week workshop, very, very powerful. You cannot afford not to use this strategy in your trading. It doesn't matter what you trade, you need to know how to hedge. It's very, very powerful, and you can really maximize profits like this. And also what you do with this, actually by hedging up, you're reducing risk, right? I'll give me 1 second, I have it here for you. Now you just need to go to the website, to my website, yeah, to the Spartan Trader website, and you will see where it says for complete details, click here. Yeah, it will be next week, Monday, always 7 o'clock, and every session will be recorded. So if you click on it, there's a small video. I will explain again a little bit, you know, sorry for that, about hedging. You see my beautiful face there, and then I explain everything. And the cost of this is $167 actually, right? That is for a whole week, and everything is recording. Okay, can you see this or not? Here again, you just need to click on the Spartan site, on the home page. It doesn't matter where you click on the home page, you will see it up here in the corner. Upcoming live events, July 21 to July 25. You just need to click here where it says for complete date details, click here. Okay, and as I said, you just click there, and then you will also see the video, and down there all the details, the sessions, what we do exactly, how to hedge, day trades, swing trades, in ranges, and also of course on the trends. And the last day, Jeff will give you one of his really easy and great strategies here. Will be a surprise actually, so don't miss out. That is really, really important for everybody. I hope you liked it. So did I forget anything? You know, we said so many things. Do we have any questions? Do you want to know something? Jeff, did I forget anything? Gail, everybody who's listening here, is there something you want me to help you with? Sorry, what question? Which recordings? This recording will be available tomorrow, right? Everybody can watch this. Crystal clear, okay. It's very easy, Duncan. You just don't tell her that you trade, right? That's what I actually did. I did when I started. I didn't tell anybody, because you know what happens when you tell people about trading. They're all like, "Oh, don't do it. It's too risky," you know, because not everybody has this mindset and wants to risk something. So sorry, Duncan, that was your fault then. It's not mine. Ah, you're funny. Great. Okay, if we don't have any questions, if you think I covered everything, then I'll hope you have a wonderful weekend. Catch up with you very soon, and hopefully I see you also on Monday in the session. Right? Great. So thank you very much, guys, and I'll catch up with you very, very soon. Bye. Thanks.